Welcome to the Honolulu Hawaii Monthly Property Report. I'm Patrick O'Neill, Principal Broker with Luxury Homes International. And with us today, one of the top economists in the state of Hawaii, President of TZ Economics, Mr. Paul Brewbaker. Aloha, Paul.
Hey, Patrick. Aloha.
So a lot of, I guess, exciting news for economists and for people following the real estate market and the economy that we'll get to. And I thought we'd start off with the monthly statistics just released by the Honolulu Board of Realtors. And let me pull up the chart here. So this is the monthly statistics just released, and it has the new format. But let's take a look at closed sales. In the upper figure, closed sales volume month over month compared to last September, down 10%. And the lower figure, year to date, down or up actually 22%. If we add the condos to the mix, we can see virtually unchanged compared to last month. And the condo sales up almost 60% compared to last year, which was an anemic year. What's your take on all this on the closed sales? Do you see anything in this data that's of interest?
The main thing in the year-to-year comparisons are the excuse me, the fact that we're in this post-pandemic period, and a year ago we were in the thick of the pandemic. Vaccines hadn't rolled out yet. People were coming back into the housing market, but that's accelerated as economic recovery has taken hold many places. And as you know, other asset classes, the stock market's done well for more than a year. And so wealth has been maintained, not just in the form of traditional asset prices, including housing, but also because of various income support programs, starting with the CARES Act under the Trump administration, and then the most recent ARPA bill that came out of the Biden administration. And so between those two stimulus or relief packages, the maintenance of wealth as with asset prices largely intact, notwithstanding disruptions to economic activity, and people are talking about those to be sure. The housing market has come along and participated in a fairly vigorous way, and has been supported by continued low mortgage interest rates.
And the dip of 10% single family home compared to last month, does that mean anything, or that's just a little blip?
I'm pretty sure that's seasonal, but I mean, we could look it up. I think right now the year-to-date figures are the best comparison, because they're really a comparison of the heart of the pandemic in the spring of 2020, and then the more recent transitional period in 2021 to date, which is a transition from pandemic to endemic biological risk. And next year will be the year that we settle in to whatever permanent presence the coronavirus will adopt, following what looks to be like a winter wave, which is now underway, a fifth wave, which a lot of us have been talking about and gearing up for, but I think is starting to catch people off guard a little bit. I don't understand why, because I mean, every time there's a wave, people are like, what? It's like, you realize we just went through 4 of these, right?
Yeah.
So
we'll talk about that a little bit, COVID. So really in this data point right here, we're really year to date is what we should be looking at. And in both of those categories, it's up substantially. So let me move on, then I'll move on kind of to our next category, which we're going to take a look at active inventory. And let me pull the statistics here. So here we have active inventory. The figure on the left would be the single family, figure on the right are the condos. Active inventory dipped, it's down 8%, this compared to last month. Condos virtually unchanged. And then let me add in the year over year change. This is pretty dramatic, down 23% active inventory, single family homes, down almost 40% for condos. What do you make of that?
Strong absorption, strong demand against a backdrop of relatively stable supply, right? The flows of listings into the market haven't really changed that much. Whereas the inventory pilot that we saw when sales initially dropped off have been drained away as sales have come back.
Yep. There you
Where I'm switching back and forth from still photo to live pattern.
That's right. And then finally, the months remaining inventory, which there really wasn't very much movement at all. I think with single family homes, we're at 1.1 as 1.2 last month. We're at 1.8 for condos. That was the same as last month. Historically low numbers, and no doubt still indicative of a seller's market. Would you agree?
Definitely a corroboration of the tight inventory that we were just talking about. I mean, 1 to 2 months is about as long as it takes to close a transaction. So that means that listings are essentially flying off the shelves, so to speak, as soon as they're put on the market.
Right. Okay. So let's talk about a big topic, which is the home prices. And last month when we talked about this, you said it was starting to perhaps look a little bubblicious. We're just going to take a really quick break. We're going to come right back and then talk about housing prices. So don't go away. We'll be right back. Okay, so we are back with economist Paul Brewbaker, and Paul, heading into home prices. This is kind of the big question right here. Let me pull up some more data here real quick. This is just interesting. I find this to be fascinating, even that we track it now, but this is property sold above the listing price, virtually no change. And certainly we're feeling that, on the ground with multiple offers, et cetera.
Yeah.
But I just I'd pull it up just more out of fascination. Okay, let's take a look next at home prices.
Well, there are two interesting things about this price relative to list, sale price relative to list price. The first is that a larger proportion of single family homes are selling above list price than the proportion of condos. 60% of single family homes, 40% of condos. That in and of itself is interesting because it speaks to a deeper pattern of housing preference shifts in the market, where the demand is strongest in the detached dwelling part of the universe. There are more condos that actually transact than single family homes in any given month or year, because they're more affordable and they're more accessible to households because of their affordability. So there's some kind of shift that's tilting a little bit towards the single family segment that at least has been ongoing through October. And we'll have to think a little about that in a second, about to what extent it is related to the legacy of the pandemic.
Right. Okay. And so let's take a look next at the pricing statistics. So here we go. The figure on the left representing the increase in single family home, or the decrease this month, which is kind of rare. We haven't really seen this in the statistics recently. So down 5%. This is just month over month. And on the right hand side, condos up almost 5%. And if we add the year to date information, we see median sales price up 19% for single family homes and up almost 7% for condominiums. So the big question for you, and I know you talked about this before, home prices, are we in some sort of bubble? Is there a correction coming? Is it already happening? And condo prices, what about those?
Yeah, so let's put that screen back up so we can look at the data while we're talking about it one more time. So again, what you're seeing here is it's not as interesting to think about whether the market as a whole is bubblicious, although there are elements of, typically a bubble occurs where prices no longer reflect economic fundamentals, sort of plausible, rational underlying economic motivations or factors which explain why prices are moving the way they are. So that's not true now. There seem to be some fundamental factors at work, and we just talked about one a second ago, this idea that one possible legacy of the pandemic is that demand is slightly more robust in the market segment for detached dwellings, and while strong, not as robust in the condo segment. And the condo segment is the more affordable segment in general. So the combination of affordability and low interest rates, which doesn't hurt, has meant that condos remain, in good shape. But for whatever reason, and as I say, there may be roots in the pandemic and its legacy, there's a little more vigor on the demand side. We saw that in the proportion of homes closed with closing prices above asking prices. And we're seeing it here in these data where both segments are strong year to date, but single family home prices have risen more than condo prices have year to date. And yet just in the last month, maybe the last 2 or 3 months, you've seen the single family home prices begin to lose that vigor a little bit. So in October, condo prices continued to rise at about 4.5%, but single family home prices in October were down year over year about 4.5 or 5%. Now, 1 month is too soon to talk about a trend, but we can look at the trends if we remove the seasonality. So why don't you let me put my screen up where I've made that adjustment to these price trajectories. And there you see an example of what I'm talking about. After COVID, there was a little bit of a lull in the spring of 2020 as people, collectively tried to figure out where we were at. And I think it's important to remember that at the moment COVID arrived, late February, early March 2020, and almost immediately had an impact on economic activity generally, on investor preferences. They scared of the stock market briefly, they eventually returned, and everybody stepped back from the housing market for a couple months before coming back strong in the summer of 2020. You can see in these price data, after adjusting for seasonality, the fact that the single family prices took off in a way that the condo valuations did not. Both, by the way, both single family home prices and condo prices right before COVID were actually tracking at the lower bound of their 99% confidence interval, sort of the bandwidth around the noise element of these time series, but they're very stable in the 20 teens, about 4% or 5% appreciation, 4% for single family, 5% for condos, until they broke apart in this post-COVID year or year and a half, maybe starting in June of 2020 and continuing through the summer of 2021. Now for single family homes, and you asked about a bubble, it looks like for a year, we had something that could have become more bubblicious, but in the event has not, because what you see since August and September and October is a retracement, so to speak, a retrenching, that the values got up to 1 million and almost immediately ricocheted off of that, perception boundary. And now the vigor that you see on the single family home market segment for the last year is not apparent in the condo segment. Condos, as I say, have tracked the path, the 5% appreciation path, albeit at the lower end of the condo price bandwidth for the last year. And so it's not that they're not participating, and they remain affordable. In fact, if anything, they remain a little bit of a bargain relative to the trend of the 20 teens. But single family homes seem now to have become a little overdone. And I'm not saying a bubble burst, because it's not as if it was an actual bubble, but there was clearly something going on the demand side of the market, maybe related to the embrace of telework and remote work and the fact that people don't have to commute the way they did pre-COVID, during this post-pandemic adjustment, firms and workers, firms accepting that in order to preserve, retain high skill, high productivity workers, they might have to move to a more flexible or hybrid work arrangements where people aren't in the office every day of the week. And workers seemingly, and particularly the higher, more highly educated, more highly compensated workers in the post-pandemic period expressing a strong preference for these new work arrangements. And indeed, I think we're going to see changes in the nature of the workplace themselves. I mean, the workplace is office spaces and you know, shifting towards collaboration type of environments as opposed to cubicles where sort of people do their private work, which they can do at home, and minimize their exposure to public health risk as a consequence.
Sure. And Paul, when we look at this chart you have pulled up here right now, the top chart showing the bandwidth for single family home.
Sorry, yeah, I forgot to put that label.
No, yeah, it's okay. But when I look at it, does this chart indicate that those prices should now, single family should come back down and be within that bandwidth?
Well, I would say that that's, at this moment, that looks like the risk, right? So one of the problems with trying to identify trends is that it takes time for them to unfold. And so if this, in fact, is sort of like, you know, a speed bump on the, you know, the Department of Transportation keeps putting these speed tables and speed bumps on the highway. Don't drive so fast. So they put a speed bump, which you have to stop for, or a speed table, which you can slow down, you know, to, let's say, 30 miles an hour to cross. It could be that this is sort of a transitory move above the trend. Now, the other thing that can happen, of course, is that the trend itself, and I'll stop sharing so that I can do my lovely hula hands, that the trend itself may have been displaced. You see what I mean? That we were on, that 4% appreciation was the correct trajectory for single family home prices, or 2% after inflation adjustments. And that 4% inflation, I'm sorry, 4% appreciation, also known as 2% after inflation adjustment, still is the correct path, but that they're connected or disconnected by the COVID event, that one's been displaced, the single family space, the single family path, whereas the other in condos has not.
And if I recall, you've shown me your data before, going back to like World War II or something, showing single family price homes, the price of single family homes. And it seemed, if you drew the bandwidth line across there, it was always within that 4.5.
Yeah, again, it
number.
takes years for these things to emerge, and then you're not sure about them. But in roughly speaking, I feel confident now in saying that adjusted for inflation, like let's not adjust for inflation. Let's assume that the inflation is still in there, because we're going to talk about inflation. And if you go back to the 1970s and early 1980s, when inflation was very high, people fled to the safe haven of housing and hard commodities like gold as asset classes to protect their investment, because no matter what the inflation rate is, a house is still a house. No matter what the inflation rate is, a ton of copper is still a ton of copper. Now, the individual prices can move around and you can get burned that way, but you can live in a house. So as I say, many people in the 70s and early 80s, when they were, you know, when the boomers were first engaged in home buying as part of their life cycle, were literally running away from inflation, trying to find safe havens from inflation, which at the time, it was not clear could be managed to lower levels. Now we've achieved that. So what's remarkable is you look at the rate of home price increase back in the 80s, and it was higher than it is in the 20 teens. But once you remove the inflation, it's that same kind of 2% number. Now, there was a chapter in Hawaii history for which I don't have quite enough data. I've got about 20 years of data before 1980, going back to the time of statehood. And the real or inflation adjusted rate of appreciation was a little higher. And if you think about the post-World War II period from, say, 1950 to 1980, you think about those 30 years, that was a period of rapid economic growth, literally the creation of modern tourism, the establishment of commercial passenger aviation. It's when we built all of our lodging units, essentially. It's when we built highways and freeways, which we're never going to do in Hawaii again. And so that period of higher economic growth was associated with higher real returns to capital, physical capital like housing. And so, yes, there was a generation, the greatest generation, as they're sometimes called, of the post-World War II period, that because they busted ass and built to modern Hawaii and created the foundation for the dividends, so to speak, the economic dividends we continue to enjoy by being able to drive over the Ko'olau Mountains on a multi-lane divided highway, that those benefits, when they were their foundation was being created, resulted in higher economic growth rates and higher returns on capital. The reason I say that is because in this subsequent interim of, say, 30 or 40 years, where the 2% appreciation for both single family and condo prices has settled in, we have moved away from rapid economic growth. And of course, we had problems to manage that originated in economic growth. So we had to shift our emphasis, so to speak, to mitigating some of those spillover effects. But in theory, if we could get that right, if we could manage the spillovers, we could also have higher economic growth. And if you listen to a lot of the dialogue today about physical infrastructure investment, the bill that Congress just passed to fulfill a longstanding, not just Democratic Party, but a longstanding political aspiration across the political spectrum for renewed physical public infrastructure investment to include bandwidth, maybe green energy. All that stuff combined with some of the social programs that are still being debated, in theory could position for a higher growth rate and therefore higher real returns to capital in the future. The stock market suggests that that possibility exists, that there's something there with AI and the metaverse and all this other stuff we don't understand that's keeping those valuations relatively high. A company that is going to make electric trucks went public recently and now has a higher market value than General Motors overnight. That may be a unicorn, or it may tell you about the potential of this technology over the next generation. So I don't want to overstate the fact that single family home prices are pulling back a little bit. It could be that the pandemic induced a one-time, like a step up, like going from one escalator to the next by having to climb a couple stairs. But it seems likely that the path overall, the 2% real appreciation, 4% after adding the inflation in, is a plausible conjecture.
And we certainly see it on the ground with single family sales. We're still dealing with 30, 40, 50, 60 offers on listings. Condos, we're not feeling that. And that's just going to increase pressure and price, push it up. So then I really want to shift into this conversation about inflation and the news from the Fed, and then how that is going to affect interest rates. So let's just take a real quick break and we'll be right back and we'll talk about that.
Sounds good.
Okay, and we're back with Paul Brewbaker. And Paul, big headlines came out this week. And for people who watch the Fed like you and I, probably wasn't a big deal. I don't watch the Fed, I know you do. But the Fed made a big announcement. They're going to start to taper off on bond purchases, which in effect can begin to drive up interest rates. But before we talk about that, consumer price index climbed 5.4% in September. And as one of the subsections in there, according to the Board of Labor Statistics, and I know there's different consumer price indices that are used. In one of the subsections of that was 10.5% increase for prices for meats, poultry, fish, and eggs. The Fed's tracking consumer prices, I think, was 4.5, the way that they calculated something like that.
For Honolulu.
Yeah, and
Oh, I'm sorry, you're right. This is a personal
yeah,
consumption expenditure inflator. Yeah.
yeah. And so it looks like we're tracking on the highest annual inflation since the early 90s. I think 1991 is the figure that's been used
Sure.
in the news, and it's certainly
Yeah.
much higher than the 2% Fed target rate for
That's
all
right.
the obvious reasons we've discussed before.
Yeah.
So now the Fed announced the tapering off of bond purchases, which was pre-announced, and you maybe can explain
Right.
what that means. But can you explain, first of all, to non-economists, why do bond purchases affect interest rates? And then how does inflation sort of complicate that and the Fed's actions throw it into the mix? Ultimately, what's going to happen with interest rates?
Well, the Fed's a big enough buyer, and was buying 80 billion, at least 80 billion of Treasury securities each month, and at least 40 billion of agency mortgage-backed securities each month. So the Fed's a big enough buyer of those securities in the grand scheme of things that the more they buy, the higher are the bond prices, and therefore the lower are the long-term interest rates on the Treasury securities, the 7-year, 10-year, so on. And the lower are the mortgage rates, which are, for which the pricing is essentially determined in the mortgage-backed securities market. So more buying means higher prices, means lower long-term interest rates. The Fed also.
So the Fed has been buying bonds
Correct.
to help keep interest rates low.
That's right.
And now they're saying we're going to taper off on that. Would that indicate now interest rates should rise?
Not necessarily. The long-term interest rate has two components. One is essentially the shorter-term interest rate, and the other component you can think of as an inflation risk premium. I'm breaking it down into two categories. There are other small ones that matter, but essentially, if you're concerned about inflation, then you might want to be compensated over time from 1 year of risk exposure to say 10 years of risk exposure. You might want to be compensated for the fact that inflation turns out over 10 years to be higher than you expected. And so that premium, that compensation inflation risk premium, shows up ordinarily in the term structure, what's called the term structure of interest rates, the difference between the longer and the shorter term securities. Now, as you mentioned, it's been 30 years since we had any inflation to think about. And at 6%, it's kind of like, ooh, we're scared of inflation. I mean, really, it's still single digits. It's not, when we were talking about a second ago about referring to the 70s and 80s was double digit, and I'm talking 15 to 20% annual inflation. And of course, places like Venezuela that have gone through hyperinflations recently you're talking about tens of thousands of percent inflation, Brazil, et cetera. So we're nowhere near that. We're nowhere near the 70s and 80s as much as many people, mostly as far as I can tell for political reasons, asserting that we are headed for 70s or 80s style.
So in your opinion, still this large parts of this would be transient?
Yeah, if you look at if you break down
inflation.
The elements, and by the way, it was 6%, it was 5.5% in September, but the October number just came out at 6%. And the breakdown, you mentioned meat prices, beef, pork, poultry, and those are supply chain and specific kinds of issues that also are related to drought and poor grain harvests and higher costs of feed and consolidation in the meat packing industry, which went through a huge disruption last year because of COVID. So all of these things are factors at work. I'm not saying it doesn't exist. You may have to think about, how much you increase your consumption of soybeans or garbanzo beans or some other alternative source of protein. But the fact is that these kinds of segments, meat, used cars, even petroleum derivatives like motor fuels, all you're really looking at is that at $85 per barrel, the price of oil is exactly double what it was a year ago at 42.5 cents dollars per bushel. So, or $40 a bushel. The doubling of crude oil prices that's been associated with global economic recovery. That is to say, after falling from $70 to $40, oil rose from $40 to $80. And so we're just at the back end of that, the unwinding of the earlier decrease. And that's why people think of it as largely rooted in transitory phenomena and not rooted in monetary or other macro phenomena that lead that inflation risk premium to go up. And you know how I know that? I can look at what treasury bond pricing is for the nominal 10-year yield, which is about 160, and for the TIPS or treasury inflation protected security yield, which is something like a negative 0.5 or negative 0.7. And the difference between minus 0.5 and 1.5 is 2%. That is, the market's actual expectation for inflation over 10 years is closer to 2.25% to 2.5% than the 6% number we see right now in the data. Which
so in other words,
the market itself is saying this is transitory.
So
forget about what you hear on TV.
This equation of interest rates, you're saying right now the inflation premium is not really affecting the rate so much. Is that fair to say?
That's right. But there is a term premium that also comes from the fact that if you have to part with your money for longer, you expect some compensation. So I don't want to. There is a hypothetical world in which so sure are we that there's no inflation, and so low is the risk-free interest rate. It's getting pretty low, by the way, that the yield curve could be flat, and we may have been moving in that direction for the last half century, and that may be a better characterization of the bulk of the 21st century than it was the 20th century. I mean, these things evolve on a grand scale across generations, and I was just looking at
if we look at this interest rate and let's just say for the time being, we take the premiums already built in for inflation. Now let's go back to the Fed tapering off on the bond purchases. Is that going to have any dramatic effect, any effect at all on interest rates in the short term, long term?
Their idea is for it not to have any dramatic effect, but they are looking for an effect. That is, if you believe that the 6% inflation is transitory and dissipates over the next 12 months, as it emerged over the last 12 months from supply chain disruptions and whatnot, then you still have the problem of ensuring that expectations of the 2% inflation down the road continue to be anchored in a reality that people perceive and a monetary policy consistent with that reality. So at some point, a year or two out, everything's got to be back in realignment the way it was pre-COVID. And it was in alignment pre-COVID. And the way you do that is you initiate now a process of unwinding the asset purchases that came with COVID. So we'll unwind that through June of next year. And they've told us 10 billion a month, starting at 80 billion in October, leaves you at 0 in June. Do the math. 80, 70, 60, 50, 40. Okay, got that? And we won't raise the short-term interest rate until after we finish tapering. That they've told us as well. In addition, a year ago, even a year earlier, knowing we'd probably be going through all this, they were saying, and by the way, 2% is not a cap, it's not a floor, it's an average. So you should expect that if we've been under for a while, like the entirety of the 20 teens, that we might be over for a little while. Don't have a cow. We'll eventually get back to 2%. And so they're literally positioning right now for a transition in policy and a gravitation of expectations around this well-anchored 2% number that is pretty firmly embraced in the bond markets.
So taking all of that and taking all the complexity, interest rates 6 months from now, a year from now, I know it's impossible to predict, but are we going to be something similar, close, maybe up a little, maybe down a little, or are we going to see a dramatic 1 point jump?
Here's one way to answer that question. What's the Fed's own forecast for the long-term risk-free interest rate? So 2%. We'll just look it up here. No, it's about 2.5%, right? So let's go to the November meeting, the September meeting, sorry, they do their projections every quarter. And so here are their projections, make full screen. And I will read from their estimate for the overnight, that's really short term, the overnight federal funds rate for the longer run. And the range is 2 to 3%, 2 to 3%. And the longer run median estimate is 2.5%. So suppose that's an overnight rate. Suppose we live in this nirvana where there's no inflation risk and therefore no reason for term premium. We live long and productive lives, right? We don't die at the age of 45, as was true when Otto von Bismarck started Social Security in Prussia in 1880. Okay, we live till 85. And so the term premium is relatively flat and the long-term rate is not that much different from the overnight rate. So let's just stipulate to 2.5%. What's the mortgage risk premium on average? 1.5%, 1.25%, 1.75%, I don't know. That 2.5% overnight longer run equilibrium is consistent with about a 4% mortgage rate, which today is 3%, 3.25%.
And the overnight rate right now approximately
was 0.
So wouldn't So wouldn't
the overnight rate
2 bring our rates up by 2%? Or
yeah, but the overnight rate let's call it 0.25 is the upper bound. It's a range from 0 to 0.25%. So that's going to go to 2.5%. Let's say it goes up, but the long run is already taking the 10-year yield is already taking into account everything we just talked about happening over the next 2 to 3 years of the next 10 years. And so the long-term rate's not going to go up by as much. Suppose it ends up at, a 2.5% overnight rate and a 3% 10-year yield and a 4% mortgage rate. I mean, I don't know, that's kind of the way I think of it. It's not going to be double digit.
Okay, so if we look out the next 12 months, maybe there's some modest movement, but we're not going to see anything real dramatic as long as everything stays the same.
Yes, the likelihood is that rates will be higher. We're coming out of a bad period for the economy, and as things get back to normal, you would look for a normalization of monetary policy, of interest rates, and of inflation. The key right now in interpreting inflation is avoid it where it exists. So if it's in used cars, don't buy a used car. If it's showing up because of shortages in semiconductors in the number of new cars that are available, maybe wait till the semiconductor industry has opened enough new foundries that the semiconductor problem has gone away. And that might be another year. I'm just saying that if it's a microeconomic problem, if the inflation is associated with specific categories of spending and not others, then the trick is to avoid those categories and wait for everything to align with the overall 2% number. What we're talking about is not showing up primarily, for example, in costs of housing, which is a big item, is showing up in fuel prices, but everybody driving around in a Tesla is going, I don't care, right? So maybe that's another reason to be thinking about whether an electric vehicle or a hybrid vehicle to avoid the volatility that we could see continuing in petroleum prices. Because remember, there's not just these macro forces at work. Even in petroleum, the prices are high partly because last week, OPEC plus Russia decided not to increase production. And OPEC plus Russia's not a member of OPEC, but it's sort of a tag-along free rider. The cartel, it's a cartel. The cartel is withholding additional oil production in order to keep prices higher and betting that those fracking Canadians or some guy in South Dakota or North Dakota isn't going to just open up the horizontal drilling pipeline that they've already drilled the pipeline. But until the price gets to a certain point, they're not going to do any more drilling. When they do drilling, they discover more oil, and they're not members of OPEC. They don't care. They sell the oil as soon as they can get it. So if they can get, the point is that at $40 a barrel, everybody went home. At $80 a barrel, OPEC plus Russia is betting that South Dakota can't respond fast enough to deliver enough oil in the market to keep the price from staying high.
Got it. Okay, so
that'll last forever.
So back to our thing. If I hear you correctly, interest rates, we should expect to just start to modestly start to increase, because that would be natural. Coming off this low, economy is going to start heating up. Nothing surprising out there right now. That could change, of course.
Well, the risk is that inflation is less transitory than we expect, right? The risk to everybody is that there's more inflation, or it's more deeply rooted, or that it builds into people's expectations. They start asking for that in multi-year wage contracts, and then it becomes embedded to a certain extent in wage inflation. So there is risk. I wouldn't say that there's no risk, but it's honestly, it's not showing up in the bond markets.
I gotcha. Okay. All right. Well, Paul, I can't tell you how much I appreciate you taking the time to go through all these topics each month. It's really a lot of fun. I learn so much every time. Yeah. So really appreciate it. Can't wait to see you next month. For everyone that's joined us, if you enjoyed this, please consider giving us a thumbs up down below. And until next month, stay safe, get vaxxed, and aloha.
Thanks, Patrick.